This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you in part by
TheStreet.com. Up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
Nasdaq 4,000. The index closes above that milestone for the first time in 13 years. But is it different now? And is the composite healthier today than it was back then?
Turnaround on track, so says Hewlett-Packard CEO, and the stock initially pops on that earnings news. What's the one thing investors need to focus on now?
And housing market momentum, prices are soaring, permits to build new homes climbing. So why is one Nobel Prize winning economist saying the move higher can't be trusted? We have all that and more tonight on Nightly Business Report for Tuesday, November 26th.
Good evening, everyone. In a year of milestones, another one was hit on Wall Street today. For the first time since the year 2000, the Nasdaq Composite Index closed above 4,000. In the 13 years since, Nasdaq, probably more than any other market barometer, has swooped and swooned and struggled to regain its former heights. The Dow and the S&P 500, for example, hit fresh records back in 2007 and again multiple times this year. Not so the Nasdaq. After cresting at 5,048 in March of 2000, it all but crashed and spent much of the past decade plus at half its former high, if that. And even today, after a 33% gain this year, it is still 20% below its dot-com era peak. Nevertheless, today's milestone is just that, a marker on a market's road to recovery. And by many measures, today's Nasdaq at 4,000 is far, far healthier than Nasdaq 4,000 13 years ago. Let's take a look at today's historic numbers. The Dow sold off into the close, eking out a fractional gain, but enough for a fresh record close. It's fourth in a row and 43rd this year. The Nasdaq was up 23 points to finish at 4,017, and the S&P 500 was up a fraction of a point.
Joining us now to talk more about Nasdaq 4,000, Jim McColgan. He's CEO at Principal Global Investors. Jim, welcome to the program. I understand that you agree with that statement that Tyler made a moment ago, that the Nasdaq 4,000 is much healthier today than it was 13 years ago. Tell us why, and what metrics are you looking at?
Yeah, the difference, Susie, is that this time the market has been going up because of earnings, and the fundamentals for U.S. private sector remain very strong. And that's really what's driving the Nasdaq. It's on 24, 25 times earnings, which is pretty reasonable, actually, given the growth potential. Equities generally on about 17 times earnings are in line with the long-term average. At a time when the U.S. private sector is doing well and there's good momentum to profits, that's actually a pretty reasonable place to be.
So this time is different in your view. Last time was a bubble. But why hasn't, Jim, the Nasdaq risen past its former all-time highs the way the Dow and the S&P have? Yeah,
the difference, Tyler, is that the Dow and the S&P didn't run on fumes at the end of the last decade, or the end of the previous decade, 1999-2000. They didn't run totally into bubble territory like the Nasdaq did. Remember, it was that extraordinary internet bubble when prices did lose touch with reality and stocks were valued well away from earnings. The difference now is we're still in touch with fundamentals. You know, a bubble could happen, but it hasn't happened yet.
So how big an event is Nasdaq 4,000, especially since it's still 1,000 points away from its real record?
Yeah, I think it's a pretty big event because the real record, as you pointed out, was in 2000, and actually the record high was 99. The last time it was above 4,000 was in year 2000, so 13 years ago, more than that. So I think it's a pretty big deal. It's a good sign of the recovery of the U.S. economy, which is what those stocks really reflect.
As you look ahead, Jim, to 2014, what are you expecting for equities?
Yeah, I'm expecting another pretty good year for equities, Tyler. I base that optimism on really three factors. The first is the U.S. has got the cheapest energy in the world, particularly natural gas. Secondly, a tremendous record of innovation and technology. The world wants to buy the stuff that the U.S. does, whether it's in electronics or aviation or other technologies. And then thirdly, we have a housing market that appears to be fairly secure in a slow recovery. These factors are really driving company profitability. The fundamentals suggest to me that all the main equity indicators might rise as much as 10 to 20% next year.
So investors have gotten very used to these, market milestones, rallies. But is there any wild card that they should be bracing for that could happen in 2014 that could end this record run?
Yeah, there is, Susie, and there are a number of things I would watch for. The first is when the Fed taper happens, which I believe it will, most likely in the first quarter of next year, you will likely see some short-term volatility, maybe a 5% setback. The answer on that for equities will be to buy into the setback. Not true in bonds. Don't touch those because yields are going up. So that would be one event that might cause some instability to equities. Another thing to watch for is the 10-year Treasury yield. If the negative action in bonds turned into panic and you got a 10-year Treasury yield currently 270 odd, if it moved up to 4%, that would be enough to choke the housing market and push the US back towards recession. I don't think it'll happen, but it's worth watching. And then lastly, you really just have to watch for any other kind of public policy error. You know, in a way, the strength of the equity market's been in spite of Washington,
Jim,
continues
I'm so
to be
sorry.
so.
You have such good thinking on all of this, but I'm afraid I'm going to have to interrupt this interesting conversation. But you've given us a lot to think about. Thank you so much for coming on the program.
Thank you, Susie. Thanks, Tyler.
Jim McColgan, CEO at Principal Global Investors.
Well, earnings out after the bell from the computer giant Hewlett-Packard, its first earnings report since it was bounced from the Dow Industrials. HP beat on both the top and bottom lines, expectations that is. Earnings of $1.01 per share, excluding items, topping estimates by a penny on better than forecast revenues of more than $29 billion. Shares initially moved solidly higher in late trading on that news, along with the company's forecast for the current quarter, a range of 82 to 86 cents a share in profit versus Wall Street's 85-cent estimate. John Fort follows Hewlett for us. What is the number one takeaway on their report today?
Could have been worse, but this isn't a full turnaround yet, Tyler. I mean, they didn't even hit the midpoint of expectations on their guidance, and yet, because they seem to be maybe at the trough and ready to turn things around, people are excited by that. The stock trading up near where it was at the beginning of August. But you got to be careful here because it's not at all clear what the catalyst is going to be for real growth if that eventually comes. PC market, as it once was, probably not going to come back. The software business that they had talked about as a growth engine for the future is actually down. They had some strength in servers and networking, but it's not clear how much of that is because Dell is doing what it's doing, going private. Some confidence shaken there in one of its traditional competitors.
Jury's still out. John Fort, thanks very much.
And we turn from technology now to some good news for housing. Permits for new home construction shot up by more than 6% in October, more than 1 million requests. That's the most in more than 5 years. Economists say that's a good sign that home building could pick up in the new year.
There was also good news about home prices. The Case-Shiller Home Price Index for September showed more than a 13% increase over the same month a year ago. That's the biggest gain in nearly 8 years.
So those encouraging figures would seem to indicate a strong recovery in housing. But Robert Shiller, the noted economist behind that Case-Shiller Index, says some investors, especially big institutional ones, may be skewing the stats. Diana Olick reports.
Permits to build new homes in October were up dramatically from a year ago, and existing home prices are soaring as well. That should be good news for the housing recovery. Or is it?
We can't trust momentum in the housing market anymore.
Nobel Prize-winning economist Robert Shiller points to investors as the culprits. Large-scale institutional investors have bought and rehabbed over 100,000 foreclosed properties, like this one in Phoenix. They pushed home prices dramatically higher, but could just as easily sway the market in the opposite direction.
The word seems to be from them that they're long-term investors, but I suspect they're not.
In fact, some may already be getting out. Institutional investor purchases represented 6.8% of all sales in October, a sharp drop from over 12% in September and nearly 10% a year ago, according to RealtyTrack.
We're seeing a sharp surge in supply hit the market in the biggest new era investor haven markets.
in Phoenix, Las Vegas, and take a look at Sacramento, California. Listings there are up 93% from a year ago, but sales are down, and far fewer of those sales are of distressed homes.
I think it's the investors lightening some load. And it makes sense. After 3 years of buying and the last year and a half buying relentlessly, many are sitting on serious gains.
Some investors are also realizing that the cost of carrying and constantly repairing these rental homes is more than they bargained for. And if they can find better yield somewhere else, they will not hesitate to go get it. For Nightly Business Report, I'm Diana Olick in Washington.
Well, even as home prices rise, some areas have a large number of homeowners who are still underwater. Later in the program, why some cities are now considering using eminent domain to fight foreclosures.
A stunning attack of Wall Street today, the global economic system, and the so-called, quote, idolatry of money. And it came from an unlikely source, Pope Francis. Eamon Javers joins us now from Washington with more on the Pope's controversial comments. So, Eamon, I understand all of this was in an 84-page document from the Pope. Tell us more about what exactly he said.
Yeah, that's right. It's called an apostolic exhortation, and it's the first major written document that we've gotten from this new Pope, Pope Francis. The Vatican has said that this document today is really an expansion on what the Pope has been saying so far in his papacy in major public speeches. But for the first time, we now have it all in one place and all in writing, and he is very critical about what he sees as the excesses of modern market capitalism. Take a look at this papal pronouncement, an excerpt from what he said today. He said, "How can it be that it is not a news item when an elderly homeless person dies of exposure, but it is news when the stock market loses 2 points?" Other areas that the Pope was very critical of today, he singled out trickle-down economics, the income gap between the rich and the poor, what he called self-serving tax evasion, the idolatry of money, and what he called the deified market. And by that, he's saying that folks have put way too much attention on profits and markets and not enough attention on basic humanity, guys.
You know, Eamon, in years past, over centuries, we've seen other popes talk about communism and capitalism. But this time, what's motivating Pope Francis, and why now?
Well, this is clearly a pope who has a reform agenda in this document. He also talks about reform of the church. He talks about a number of other wider issues. But he says here that the pope loves rich and poor alike, but he has a special message for the rich, which is that they must do their duty to help the poor.
Eamon Javers, thanks very much. And still ahead, from Vatican concerns about the idolatry of money to a business that, right or wrong, in some ways is all about that, gambling. As more and more of it takes place online, we take a look at an industry in transition.
New Jersey just made a very big bet. It's the third state in the nation to allow online gambling. Proponents say it'll bring billions in revenue for Atlantic City's struggling casinos and millions more in taxes for the Garden State. But as Brian Sullivan shows us, this new way to gamble is just a small part of how the entire gaming industry and where betting is taking place is rapidly changing.
It's an industry in transition. 2 years ago, the Obama administration cleared the way for states to legalize online gambling. Today, New Jersey joined Nevada and Delaware as the only states that allow it, though that number could jump to 21 within the next 5 years.
I think internet gaming / gambling is just an inevitable thing at this point. You know, states need revenue. Gambling does that. You don't need to build these big casinos all over the place. It's all done through the web.
And while analysts don't expect today's announcement to have much of an impact on revenues at the big gaming companies, it could signal that a change is on the horizon. U.S. casinos generated revenues of more than $37 billion last year, up nearly 5% from 2011, and the highest figure since 2007. But the states leading that growth might come as a bit of a surprise. While gambling meccas Las Vegas and Atlantic City are still the top grossing casino markets, in 2012, consumer spending in casinos grew at just 1.5% in Nevada and fell 8% in New Jersey. The big winners? States that opened new casinos, like Kansas and Maryland, that each saw triple-digit jumps in gaming revenue.
Gambling brings a lot of tax revenues, and it brings a lot of jobs, and good-paying jobs, and that is the lure for states.
The gaming industry says it paid $8.6 billion in taxes last year, and a handful of states, driven on by the promise of new jobs and a share of that tax revenue, are considering expanding gambling. Earlier this month, New York approved a proposal to open 4 new casinos upstate, while Pennsylvania legislators approved a bill that would allow limited gambling at thousands of bars across the Keystone State. And with those changes taking place in Atlantic City's own backyard, it's no wonder that New Jersey, home to the city once touted as America's playground, is an early adopter of online gambling. For Nightly Business Report, I'm Brian Sullivan.
Well, if you were betting on making big money from a merger or acquisition this past year, the winnings may be a bit disappointing. Data from Dealogic reports that companies taking over other companies paid just 19% more on average than their acquisition target's trading price 1 week before the deal was announced. That is the lowest takeover premium since at least 1995. That's as far back as records go.
The suit wars continue now with Men's Warehouse offering to buy Joseph A. Bank, and that's where we begin tonight's Market Focus. Men's Warehouse turned the tables on Joseph's with a $1.5 billion proposal to acquire its smaller rival that's been trying to take it over. The combo would create the 4th largest men's apparel retailer in the U.S. Shares of the chains surged on the news. Men's Warehouse up 7.5% to $50.60. Joseph A. Bank rose 11% to $56.29. Well, Tiffany's shined in today's trading session after reporting earnings way above estimates. The jewelry maker's solid quarter was driven by strong sales in China. Tiffany also upped its full-year forecast. Shares jumped more than 8% to $88 and change. It was a different kind of story at DSW. Shares tumbled after the footwear retailer reported improved sales for its latest quarter, but they were still below analysts' expectations. Investors were also disappointed by DSW's modest outlook. The stock dropped almost 5% to $44.95. A big jump in fourth quarter profits at Hormel, up 19%, thanks to its recent purchase of Skippy peanut butter, a boost in turkey sales, and in refrigerated foods. The CEO said, despite rising commodity costs, the food producer will continue to deliver strong results.
Well, there has been significant food inflation over the past few years. Certainly on our Jennie-O turkey store side, we've ended up having to push prices to keep up with those cost inputs. I do feel heading into the next year, we're now in a little bit more benign environment that should allow consumers to really enjoy our products, and we intend to support a number of our products with ad campaigns heading into the new year.
The stock popped nearly 6% to $44.95.
Well, Susie, Workday, a provider of web-based human resources software, forecasting revenue well above expectations. The company reported a big jump in quarterly sales, helped by strong growth in subscriptions. Workday competes with Salesforce and Oracle in the fast-growing cloud software market, and the report sent shares up more than 12.5% to $82.60. Barnes & Noble, meanwhile, reporting an 8% drop in quarterly revenue. Sales fell across all of its businesses, including its stores, its Nook e-readers and e-books. The bookseller also cut costs in the most recent quarter. Today's closing prices reflected growing fears here, the stock dropping about 6% to $15.45. Well, investors have been pressuring the struggling teen retailer Aeropostale to sell itself. But the company says no way. The clothing maker responded by adopting a shareholder rights plan in case a stockholder buys 10% or more of the company. This will protect itself from a buyout. The stock closed nearly 2% lower to $10.03. And declining sales in its Boston proper catalog business dragged Chico's down to a third quarter loss, but the clothing chain announced a quarterly dividend boost. That took some of the sting out of the loss. The shares up 4% to $18.65.
Here's some good news for retailers. Moody's Investor Services now expects Americans to spend more money this holiday shopping season, as much as 5.5% more than they did a year ago. Moody's credits pent-up demand for new video gaming consoles from Sony and Microsoft, as well as what it calls an easing up of worries about fiscal uncertainties.
Well, that's good news just ahead of this week's Black Friday shopping palooza, which has become a tradition for many American families. It's the unofficial kickoff of the holiday shopping season. But since Thanksgiving is a uniquely American holiday, big retailers are now trying to give the sport of Black Friday and Cyber Monday shopping a more international flavor. Courtney Reagan has our surprising story.
From China to Russia to Mexico, they may not celebrate Thanksgiving, but more and more global consumers are coming to know what the day after means. 50% off cashmere sweaters, thanks to the help of company Border Free.
So Black Friday and Cyber Monday are the 2 days, the highest days of sales that we see from all the way around the world. So I think it's an interesting way that we've sort of exported our American retail culture.
Border Free works with many American retailers, including J.Crew, Aeropostale, and Neiman Marcus, to convert e-commerce websites to country-appropriate language and currency translations. Once an order is placed, Border Free steps in to help facilitate shipping, taxes, and tariffs. Macy's.com and its Bloomingdale's web businesses ship to more than 100 countries. The retailer acknowledges Black Friday and Cyber Monday are very busy days everywhere. Saks says last year it saw a significant increase in international traffic and sales during its post-Thanksgiving events like Black Friday and Cyber Monday. The retailer expects the same occurrence this year. The high-end department store says significant international sales are done in Canada, Australia, Russia, the Middle East, and Asia. So why the international demand for American retail?
So it's not just a price thing and it's not just a selection thing, but it's a combination of the two. Interestingly, the number 3 reason is so people think I recently went to the United States.
For Nightly Business Report, I'm Courtney Reagan.
And coming up on Nightly Business Report, some cities are considering using eminent domain to fight foreclosures. But could the program actually hurt the homeowners it's designed to help? The U.S. banking industry continued its turnaround over the just completed third quarter, pulling in $36 billion in profit. But the FDIC says that's less than banks took in during the same period a year ago, and it's the first time that's happened since the financial crisis in 2009.
An auto recall to tell you about Ford recalling 161,000 brand new Ford Escape SUVs because an engine cylinder head can crack and leak oil and could cause a vehicle fire. This is Ford's 7th recall this year for the 2013 Escape.
How many Americans are worried about their jobs and the economy? Apparently, a lot. A new survey by the Washington Post shows that more than 6 in 10 American workers say they're worried about losing their jobs. That's the highest level since the survey began in the 1970s. The newspaper also says that anxiety is highest among low-income workers.
A lot of Americans also worried about losing their homes. And in one California city plagued by foreclosures, officials have come up with a controversial way to keep struggling homeowners in their homes by invoking the right of eminent domain to take over those properties. But will it work? Jane Wells takes a look.
Realtor Jeffrey Wright walks through a bank-owned home in Richmond, California, a city which the mayor said had 1,000 foreclosures last year, and where a plan to use eminent domain to buy underwater mortgages isn't going down well.
Anytime you have an involuntary and hostile set of circumstances, there's likely to be adverse consequences.
Wright holds a list of the 624 homes a firm hired by Richmond is targeting to buy from banks at current market values and then refinance to be affordable. The mayor says it'll keep people in their homes and save Richmond millions in foreclosure fees.
We're seeking a voluntary purchase from the banks, and if they won't sell to us voluntarily, we will utilize our legal authority of eminent domain. And this is, again, a last resort.
No bank has volunteered, but the city council doesn't yet have the votes to force eminent domain. Critics say many of the targeted homes are in nice neighborhoods. 2 are on this street, and the loans aren't even delinquent.
Some banks have sued, but a judge ruled it's too early for that. The plan hasn't even been approved yet. But other cities are considering using eminent domain this way, though some don't want to risk the expensive lawsuits which will surely follow.
Chicago has rejected it. Brockton, Massachusetts had looked at it and rejected it. And most recently, North Las Vegas has examined it and decided that that was not for them.
Now Richmond's mayor is talking to other California cities and wants to form a joint powers authority to take on the banks with more clout.
I mean, we've waited for years for the banks, for the federal government to step in and provide a solution. It hasn't been forthcoming. So the city is doing this common sense fix.
Jeffrey Wright believes the fix is in. If the plan passes, investors won't want to make loans in Richmond. And he says it's giving false hope to homeowners, like one who pulled out of a short sale banking on the mayor's proposal.
So there's a high likelihood that this person may very well lose their property when they could have sold it on a short sale because they're waiting on a program that's not even up and running and may never be up and running.
It may not get up and running here, but with other cities still trying to solve the foreclosure crisis 5 years in, it may get going somewhere. For Nightly Business Report, I'm Jane Wells.
And that's Nightly Business Report for tonight. I'm Susie Garib. Thanks so much for watching.
And thanks from me as well. Have a great evening, everybody, and we will see you back here tomorrow night. Stay dry, stay out of the rain. Watch the storm.
Nightly Business Report has been brought to you in part by
TheStreet.com, up-to-the-minute stock market news and in-depth analysis. Our quant rating service provides objective, independent ratings daily on over 4,300 stocks. Learn more at TheStreet.com/NBR.
I'm Susie Garib with the Nightly Business Report News Brief. In a year of milestones, another one was hit and passed on Wall Street today. For the first time since the year 2000, the Nasdaq Composite Index closed above the 4,000 level. The Nasdaq rose 23 points. The Dow and the S&P sold off into the close, both eking out fractional gains on the session, but just enough for a fresh record close on the Dow. Home builder stocks jumped after home prices in September shot up 13% from the year before, while permits to build new homes rose to a more than 5-year high in October. And in Hewlett-Packard's first earnings report since leaving the Dow, it made $1.5 billion in profit, mostly due to cost cutting, not sales of PCs. Be sure to tune into Nightly Business Report right here on your public television station.